We talked already about finances. We talked about the stock market. Let's now talk about the bond market. The bond market is always into stocks and bonds. You mentioned it. They're really two different elements altogether. When you buy a share of stock in the corporation, you're buying a share of ownership in the corporation. When you buy a bond, it is not a stock. It is not a share of ownership in the corporation. It's a certificate of debt for the organization. They're borrowing money and you're the one that's loaning them the money. So if you spend, let's say you get a $10,000 bond, which is a pretty common level of loan to the organization, you get a certificate indicating that you lent money to the firm. The money you lend is the principal, which is the face value of the bond. Now, by the way, on the bond, sometimes you're going to pay a premium, sometimes you'll pay a discount. It's actually pretty rare that you buy a $10,000 bond for $10,000. It's going to depend upon all the different aspects as to the maturity date, the interest rate it's paying. If the market right now, if the Fed rate out there, if the Fed is out there and they're charging people 7% in the process, and you have a bond, and the bond is out there and it's paying everybody that loans it money 12%. So all of a sudden you're going to make 5% more than the Fed. Oh my gosh, this is a fabulous bond. You may take that $10,000 bond and you may buy it on the secondary market out there and pay $12,000 for that $10,000 bond because the interest rate is so good and is doing better than the whole market as a whole. And also you have the counter effect of your $10,000 bond. If the market out there is paying 7% and all of a sudden the bond is paying 2%, you're going to look at that and say, I don't want that thing. But wait a minute, I can buy it on the secondary market. I can pay $7,000 for a $10,000 bond. All of a sudden now you start thinking maybe that's a deal. So just because it's a $10,000 face value, in other words, right on the face of it, and the principal is the face value of the bond, that doesn't mean that's what the price you're going to pay for it is. It's going to depend what the market has in it. So a couple things you have to know. First of all, what is the face value of the bond? A lot of times it's a $10,000 increment, sometimes 100,000, depends how much money you have and how much they're selling for. So you have that. You might pay a discount or a premium or less than the face value or more than the face value. It'll tell you the maturity date on it, which is the date that the corporation must pay back. Now, keep in mind that a lot of times bonds are callable. So in other words, if the bond is going to sit down has a maturity date of 2032, if that's on the face of it, and the year is 2027, they may have a huge amount of money and want to retire debt. So instead of them having the bank of cash, they want to sit down and just pay back everybody that has the bond. They might have a call date, and they say, "Hey, we're going to call the bonds back," and you may be paid the face value of the bond before the maturity date. So the maturity date is on the bond. They're required to sit down and pay you back that money on the face value of the bond by that date. A lot of times there's a provision in there to pay it earlier. So pay attention to what is on the bond. Now, here's some government bonds because not just corporations sell it, but the federal government does. And this is one of the tools they have to sit down there and add money to our economy or subtract money from our economy by having this. So on the bond, you'll see there's a government bond, there's T-bills, there's T-notes. We call a treasury bill a T-bill, okay? And the treasury note a T-note, and the treasury bond a T-bond. So that's kind of the slang that we use. And then also you have municipal bonds, which deal with local bonds. And then you have a Yankee bond, which issued by a foreign government in the process as well. So you have different kinds of bonds out there, government securities versus that, and they all have different lights. Like a bond is typically a 30-year critter when it's first issued. A T-bill is a lot of times it's a short term, less than 1 year, and a note is something in between. So you'll see different bonds in the process out there. I spend a lot of times buying bonds before in the aspect I worked in a corporation and I had to have a secure interest. So instead of my just putting money into getting certificates of deposit from banks, I was buying different types of government bonds and I was playing a little bit with the market over there. And surprisingly, I stopped buying the different treasury stuff. I was buying different government agency bonds because they're still secured. It just I made more interest off the top of it. So that's kind of an interesting thing to play out there. It is a market all by itself. trying to make certain that, because no matter what happens, if you buy a government note of some type, it is insured by the federal government. And unless the government goes belly up, which means we're all in trouble anyway, you'll get your money back, period. So it's a safe investment. This is the safest you can possibly get. Interest, okay, that's going to be on the face of the bond as well. Okay, we sometimes call it the coupon rate. Now, if you ever deal with people that are extremely wealthy, a lot of times they go home and they clip their coupons. That's a slang term because once upon a time you would get a bond certificate, and lining the edge of the certificate would be coupons on it that you would actually clip off and take to the bank, and the bank would actually give you the money for that coupon, and the coupon was your annual interest payment you would get from the bond. We call that the coupon rate because it was printed right on the coupon. So sometimes the bond interest rate could vary depending upon the government's rate. So it depends a lot. So that's the aspect of the discount and the premium. You'll see what that is. But regardless, there's an annual interest payment that is made on the bond by the corporation, and we call that the coupon rate from the slang of the original term of having a paper document. Bond ratings also depends upon how stable the company is. If you're going to sit down and buy Willie and Joe's air conditioning bonds, that's a different critter than buying a General Motors Corporation bonds. If General Motors goes belly up, and it has, the government stepped in to save it because it'd be massive unemployment for hundreds of thousands of workers. So you have, to some extent, a lot of security, and it's an old corporation. Really, Willie's a little air conditioning company is not very big, so it's not very dependable. So you're going to sit down and have a different aspect as to what's out there. Here's actually a picture of a bond, and you really want to watch them. There's a lot of different things on bond yields. They really are a key economic barrier, and there's an article there if you want to pop open this off the PowerPoint, you can do that as well. Bond ratings are done by different organizations. The most famous is always the Moody's, Standard & Poor's, and Fitch. These are the three big ones out over there. You would, if General Motors is going to sell a bond, almost for sure it's going to be a AA or AAA. Billy's and Willie's air conditioning service probably is not around all that long, certainly not as long maybe as General Motors. Maybe it's 100 years old, but more likely it's about 5 years old. And I'm not certain I would trust Billy and Willie in their air conditioning company. They would probably get a lower rating no matter what happens. Regardless, if it's a high quality rating company, then you sit down and you look at it as to, okay, I got this over here. And if it doesn't get a triple A rating and it gets a double A rating, it's still extraordinarily good. If it gets an A rating, it's good. Okay, and then you get into B's, and all of a sudden a few flags go up. And usually what happens is if you're selling bonds, a $10,000 bond, triple A rated, that's paying something comparable to the market rate interest, is probably not going to be discounted much compared to what's on the face value of it. But as you're getting down into lower grade bonds, all of a sudden now it becomes speculative. Finally, all of a sudden you hit a B bond. By B bond, all of a sudden it becomes a junk bond. Oh no, I'm buying a junk bond. A junk bond means exactly what it says. It could be a piece of junk, and it could be you'll be paying. You'll get, oh, if I buy this, it's a $10,000 face value, and it comes mature in 3 years, and I'm going to get 16% interest once they calculate it because I'm buying at half price. Oh, what a steal! Oh yeah, if they're around to pay off the bond in 3 years. That's what we call them junk bonds because they're very speculative and they're very dangerous. So the advantages of issuing bonds is their bondholders are creditors, not owners. They don't get to vote. You get to do whatever you want to, and without accountability to them. The bond interest is tax deductible. They're a temporary source of funding. You eventually have to repay them, and they can be repaid before the maturity if they're callable, which most bonds really are. The disadvantage, all of a sudden now your firm is increasing debt, okay, and that can affect the market's perception of the firm. So if you're selling stocks and bonds, which is a pretty common aspect of it, all of a sudden now you're carrying this debt over here, and people may get nervous that you have too much debt. You're paying interest on bonds. It's a legal obligation. It's not like a dividend. You can postpone a dividend or not even pay it. But on a bond, no matter what happens, you have to have that and pay it out because it's a legal obligation. If it's not paid, the bondholders can take legal action. The face value of the bond must be repaid on a maturity rate. no matter what happens. So you have a couple things to worry about with the bonds. It's not spectacular. And even though there's different aspects of it, a different class of bond, the unsecured bonds know the term, we call them a debenture bonds. In other words, there's no collateral to back it up. Okay, so they issue it on good faith. General Motors can issue on good faith, but a lot of times General Motors issue it based upon a plan. They want to open up or redo an entire plant. Let's say they want to open up, take a plant and convert it to electric vehicles. So they may sell bonds just for that one plant, and they secure it with collateral to the plant itself. So you'll see a secured bond, but or debenture bond. It just depends what it is. There's two different terms. Secured is a secured bond, or an unsecured, we call it a debenture bond. You also have to have a sinking fund. No, this is not about ships. Okay, a sinking fund is where you pour money into an account in anticipation of saving money to pay back the bonds. So if you're smart on the inside, your chief financial officer will be putting money into a savings account to pay off the bonds whenever they become mature. So it's the year 2027. You're looking at the bonds. You check their spreadsheet. They have a thing called a sinking fund on their spreadsheets, and they're saying, okay, the sinking fund, they have $5 million over here in preparation to pay off the bonds in 2032. So you'll see a sinking fund there. That's what it is there. So a lot of times the bonds are callable. They can pay off their principal before the maturity dates. And sometimes they're convertible bonds. And no, that's not for convertible cars. That's for the bond can convert a lot of times into shares of common stock on certain conditions. So normally you have to hold them for a couple of years, but regardless, you can sometimes convert the bonds into stock, which is kind of an interesting aspect of it. So bonds can have all kinds of really cool features. You can have secured and unsecured bonds. Debenture bonds are bonds that are unsecured. Okay, the bond rating plays a big deal. There's a maturity date on the date on the face of the bond, and also you have to have a sinking fund to repay them because no matter what happens on a bond, you must repay them. It's not like dividends. So stock, yes, you have ownership in the company. You don't have to repay anything from that. A bond, there's no ownership, but you have to repay it in the process. And there's a lot of money tied up in the bond market, both in the private sector and in the government sector. Bonds. Interesting way to go. It's a good thing to have as part of your overall portfolio if you're invested in different aspects and have a portfolio of different types of investments. Take care.